Good morning. My name is Frank Grinnell. I've been advising professional money managers and investing in the stock market for over 20 years. It serves as my day job, but most importantly, it is my absolute passion. On Street Views, I offer my daily viewpoint on the stock market in under 7 minutes. I will cover things like the global macroeconomic picture, the mood of the market, company-specific news, secular trends with some actionable sector and stock calls. I hope my insights are useful to you, whether you are a professional money manager or a passionate investor. At Grinnell Capital, we actively manage dynamic stock and ETF models for financial professionals and their clients, as well as individual investors. If you want to learn more about what we do, send me a note, frank@grinnellcapital.com. You can also find more of my insights on Twitter @GrinnellFrank. And now, today's Street Views. Hey, good morning. July 13th, Wednesday, CPI is out and it's hot. 9.1 is the year over year, 1.3 on a month to month. That's probably almost the more scary component. You've got that core number stubbornly high and arguably and definitely higher than consensus. That's going to be a big worry for the Fed. Now we see the bond market reflecting a 30% chance of a full 1% move at the end of the month. I'm not sure that happens, but that is the dialogue out there. So just looking around the globe real quick, you look at emerging markets, the strength in the dollar, and in terms of their bond markets, that's the biggest risk in terms of exposure that anybody might have out there. That's the part that's really at risk of breaking. You look at places like Egypt. Not that anybody has a lot of exposure to Egypt necessarily, but their bond market is essentially already broken. So anyway, but taking a step back, keep in mind that inflation is a trailing indicator, right? So these numbers that we're seeing are results of activities that were several months ago. The current environment, everybody knows, commodities can't get out of their own way. Things are slowing across the board. Prices are coming in. On most items, airfare probably joins that party as, demand cools with summer now half over, housing coming in. So I think the narrative does continue to move from inflation to slowing growth. I think that does become the bigger concern, even though it seems, this inflation number is pretty huge. But so with that in mind, what kind of things make sense? And I do go back to thinking about the yield curve in the treasury market in terms of that longer dated duration type stuff. TLT, we reinitiated a small piece yesterday. We're probably going to buy more today on the dip, again with the thought that the narrative does shift back to slowing growth, which would benefit fixed income. But in terms of stocks, energy actually looks a little bit interesting here. If you think about exploration and production, I did just talk about commodities can't get out of their own way, but nat gas with the dislocation still in Europe, it does look interesting. You just think about the steady LNG exports we're going to be sending over there, especially once the Freeport plant gets fixed up later in the fall. And the Chesapeake, CHK, that's seen some insider buying, quality asset. That one looks interesting. It's got a huge pullback, still intact technically. Another one we own, we do own some AR. You could also look at Pioneer and EOG, what have you, Oxy, Buffett's favorite, Oxy. He'll be back there buying more in the mid-50s. Seems like he always does when it dips down there. That's something to try, something to keep in mind. I think that aerospace and defense might be worth the dusting off. Lockheed Martin's come in quite a bit. Raytheon has come in a little bit. The other interesting thing, you've got secular demand for obviously their products, but you've also got declining commodity prices. You've got declining raw material costs. So these guys are going to start to benefit from the pullback in steel. They're going to start to benefit from the pullback in all these components. So that's going to be a positive when it comes to margins. That's obviously looking forward, but still that's something to keep in mind. And the triple Qs, we're going to probably gap below that breakout to the upside of that downtrend that we had marked at what was around 285 or so. It looked like it was 280. I think now it's probably lifting a little bit off those lows, 281 or 2. If we can close above that downtrend, I think that would be still interesting to keep that somewhat of a breakout above the downtrend intact. No need to be a hero, but definitely worth watching. And the VIX did spike pretty good on that print, but that's been pulling back. So I don't know. Who knows? We could even turn green today as people were maybe somewhat expecting this. Shorts get covered and what have you. So we will see. Interesting time. It's got that Super Bowl type feel, doesn't it? Okay, that is it. Have a great day. Talk to you tomorrow.
And now for some important disclosures. Grinnell Capital is a state-registered investment advisor. Services offered by Grinnell Capital can only be offered in certain states where Grinnell Capital is registered or meets required exemptions. Registration does not imply a certain level of skill or training. For additional information about Grinnell Capital, including its services and fees, please review the firm's disclosure statement as set forth on Form ADV and available at no charge at advisorinfo.sec.gov. This podcast is provided for informational purposes only. The information contained herein should not be construed at the provision of personalized advice and is subject to change without notice. This material should not be considered as a solicitation to buy or sell any asset or engage in a particular investment strategy. Investing in securities involves the risk of loss, including loss of principal invested, and may not be suitable for all investors. Past performance is no guarantee of future results. This podcast contains certain forward-looking statements which indicate future possibilities. Actual results may differ materially from the expectations portrayed in such forward-looking statements. As such, there is no guarantee that any views and opinions expressed will come to pass. All expressions of opinion reflect the judgment of Grinnell Capital as of the date of publication and are subject to change without prior notice. This podcast contains information derived from third-party sources. Although we believe these sources to be reliable, we make no representations as to the accuracy of any information prepared by any unaffiliated third party incorporated herein and take no responsibility therefore. This podcast is provided with the understanding that Grinnell Capital is not engaging in rendering legal, accounting, or tax services, and we recommend that you seek out the services of professionals in these aforementioned areas. The principal investment focus of the accelerator model, the strategy, is to achieve strong relative and risk-adjusted returns, primarily by investing and trading in securities issued by companies that focus on the global information, technology, consumer, healthcare, industrial, and infrastructure sectors. These sectors are characterized by robust secular growth, an abundance of both new and maturing product cycles, a high degree of competition that creates the potential for relative winners and losers within a subsector or theme, a high degree of revenues and earnings volatility, rapidly changing sentiment and public perception, significant yet unrealized potential for globalization, and superior relative liquidity. Investment in the strategy is speculative and involves a high degree of risk. The second investment model is called the ignition model. The ignition model is an all-exchange-traded fund, ETF, strategy with investment objectives similar to the accelerator model. This model seeks to capitalize on long-term growth trends experienced by the market leaders in various areas and sectors. The ignition model will also seek ETF investments based on cyclical forces experienced in the U.S. and the global economy. This model is also designed to have the ability to offer some downside protection in the event of significant market stress through investments in ETFs designed to take advantage of market volatility. The strategy's performance can be volatile. Grinnell Capital has total trading authority over the strategy. The use of a single manager applying similar trading programs can mean a lack of diversification and consequently higher risk. For more important disclaimers, please visit our website, grinnellcapital.com.